Starting this July, some seniors could get a major medication for just $50 a month. Some New Jersey homeowners could see their property tax relief change in ways they did not expect, and some public retirees in Louisiana and Mississippi may have new income or pension flexibility. Here's why so many people miss updates like these. The rules are not simple, and in one case, what sounds like a benefit expansion is actually a tighter limit for many households. It is very easy to hear one headline, assume you qualify, and make the wrong decision. In this video, I'm going to walk you through all three changes in plain English: who may qualify, who may not, and the costly misunderstandings to avoid. There's one detail in the New Jersey update that surprises a lot of people, because it changes what some seniors thought they were already going to receive. If you're a senior, or helping a parent, spouse or client keep up with benefits, July 2026 brings a few changes worth paying attention to. But before we get into the details, let me make one thing clear. Not every change in this video applies to every viewer. One is national through Medicare, one is specific to New Jersey homeowners, and one affects certain public retirees in Louisiana and Mississippi. My goal here is simple: help you figure out which of these changes applies to you, what it really means, and what step to take next. Because here's what most people don't realize. A lot of benefit confusion doesn't come from the headline. It comes from the fine print. That's where a costly mistake can happen. Let's start with the nationwide change. Major point 1. Medicare's GLP-1 Bridge Program. Beginning July 1, 2026, eligible Medicare Part D enrollees may be able to get certain weight loss GLP-1 medications for a flat $50 monthly copay through the new Medicare GLP-1 Bridge Program. This matters because, before this change, Medicare Part D generally did not cover drugs prescribed only for weight loss. Many seniors interested in drugs like Wegovy or Zepbound were facing the full retail cost, often around $1,000 to $1,350 a month. That's simply out of reach for a lot of people living on a fixed income. Here's the part that matters though: this isn't Medicare suddenly changing all standard Part D rules. According to the research, this program is being offered through a temporary federal demonstration model running from July 1, 2026 through December 31, 2027. Under this bridge program, participating manufacturers provide certain covered GLP-1 drugs at a negotiated price, and eligible seniors can get them for a $50 monthly copay. Covered formulations include Wegovy, Zepbound, and Foundayo. That sounds like broad access. But this program comes with strict clinical rules, and this is where people get confused. If your body mass index, or BMI, is 35 or higher, you may qualify without needing an extra health condition. If your BMI is 30 to 34, you may qualify only if you also have heart failure, uncontrolled hypertension, or stage 3A or worse chronic kidney disease, and if your BMI is 27 to 29, you may qualify only with prediabetes, a past heart attack, stroke, or symptomatic peripheral artery disease. This is not a program where everyone who wants a weight loss drug can simply ask for one and get it. Let me give you a realistic example. Say a 69-year-old retired teacher has a BMI of 36 and has been struggling with weight-related joint pain. Before July 2026, she may have had to pay the full retail cost of Wegovy, nearly impossible on a $2,000 monthly pension. Under the new bridge program, she may be able to get prior authorization from a prescriber and receive the medication for a predictable $50 copay at a participating pharmacy. That's a meaningful change. Here is the common mistake though: a lot of seniors assume this $50 copay works like normal Part D spending and helps them meet their deductible or annual out-of-pocket cap. It does not. Because this program sits outside the normal Part D coverage flow, those bridge copays don't count toward the Part D deductible, and they don't count toward the standard out-of-pocket cap either. That surprises a lot of people. There's another important limitation. This program is for people who are not already getting a GLP-1 through their standard Part D plan in 2026, and who are otherwise ineligible to receive that drug under standard Part D coverage. So if someone is already receiving a GLP-1 through Part D for diabetes or another covered condition, This bridge program may not apply to them. Low-income cost-sharing subsidies also don't reduce this copay further. Everyone in the program pays the same flat amount. What's the practical action here? If this may apply to you, ask 3 questions. First, am I enrolled in a standalone Part D plan or a Medicare Advantage plan with drug coverage? Second, do I meet the BMI and health condition criteria described in the program? Third, have I already filled a GLP-1 prescription under my standard Part D plan in 2026? Then speak with your prescriber and confirm whether the pharmacy and drug are participating under the bridge model. That's the safe next step. Let's shift to a very different kind of change now, and this one matters a lot if you live in New Jersey. Major Point 2, New Jersey's Stay NJ Property Tax Relief Changes. Starting July 1, 2026, New Jersey restructured its Stay NJ Property Tax Relief Program. For some seniors, this will preserve help. For others, it will reduce or completely eliminate what they expected to receive. Property taxes are one of the biggest ongoing housing costs for older homeowners, especially retirees trying to stay in place on a fixed income, which is exactly why this change carries weight. The original idea behind Stay NJ was broader, but under the new rules in the fiscal year 2027 state budget, the income limit drops to $200,000, and the benefit now works in tiers. Here's how the tiers break down. If household income is $100,000 or less, the maximum Stay NJ benefit remains up to $6,500, covering up to 50% of the property tax bill. If household income is $100,001 to $150,000, the cap drops to $5,000. If household income is $150,001 to $200,000, the cap drops to $4,000, and if household income is over $200,000, the benefit is zero. That's a major change. Let me give you 2 examples to make it concrete. Imagine a 70-year-old retired public worker in Middlesex County with household income of $95,000 and a $10,000 property tax bill. Under the new rules, she could still receive a $5,000 Stay NJ credit because that's half the tax bill and still under the $6,500 cap. Now compare that with a neighboring senior earning $210,000 under the new July 2026 rules. That homeowner is disqualified entirely and would receive nothing through Stay NJ. This isn't just a small adjustment. For some households, it's the difference between meaningful relief and no relief at all. Many people are likely to get tripped up on one point though: the transition year isn't as simple as expected. Some taxpayers had already received their first 2 quarterly payments for the 2024 benefit year and expected the final 2 checks to match. Under the new budget structure, those final checks are cut in half. That means the maximum total benefit during this transition year is capped at $4,875, not the previously expected $6,500. On top of that, the separate $250 Anchor bonus some seniors were used to seeing is no longer included. If a viewer says, "Wait a minute, I thought I was supposed to get more," that confusion is understandable. Eligibility isn't just about age and income either. You must be at least 65, must have owned and occupied the New Jersey home as your primary residence for the entire prior year, and must meet the new $200,000 income limit. You'll also need to apply using the PAS-1 combined application, designed to let eligible residents apply for Stay NJ, Anchor, and Senior Freeze together. The filing deadline is November 2, 2026. An important date to have on your calendar. One more detail worth understanding: Stay NJ is calculated after Anchor and Senior Freeze are determined. The final Stay NJ payment equals 50% of property taxes, minus amounts already received from those 2 programs. So the number isn't always as simple as looking at your property tax bill and cutting it in half, a common misunderstanding. The practical action here is straightforward. If you're a New Jersey homeowner age 65 or older, check your household income, confirm you meet the ownership and occupancy rules, and file the PAS-1 form on time. If your income is close to one of the cutoffs, pay extra attention. Even moving from one tier to another can change the size of the benefit. One limitation worth flagging: the research also raises concern about a renter gap, since renters may only qualify for a much smaller anchor benefit while the stronger Stay-NJ relief remains reserved for property owners. If you rent in New Jersey, this particular program may not help you the way it helps homeowners. Next, the third update. This one is about state pension systems adjusting to inflation and labor shortages. Major point 3. Pension COLAs and return-to-work flexibility in Louisiana and Mississippi. Starting July 1, 2026, Louisiana and Mississippi both activated pension-related changes, but they're solving two different problems. Louisiana is addressing inflation pressure through a limited cost of living adjustment. Mississippi is addressing worker shortages by making it easier for some retirees to return to public employment without giving up their pension. Retirees in public systems often depend on predictable rules, and even a modest change can affect monthly income, work decisions, and retirement timing, which is why both updates deserve attention. Louisiana first. The state authorized a 2% cost of living adjustment for the state employees' retirement system, effective July 1, 2026. Here's the important detail though, that 2% adjustment applies only to the first $81,201 of annual retirement benefits, and it is not described as an automatic annual increase going forward. To qualify, a retiree must be at least age 60 and must have been receiving benefits for at least 1 year by June 30, 2026. This is helpful, but limited. A common mistake would be assuming every Louisiana public retiree now gets a permanent annual 2% raise. Future COLAs still depend on legislative approval and the financial status of the dedicated accounts. The practical action for a Louisiana retiree is to confirm your age, your benefit start date, and whether your pension falls under the system covered by this adjustment. Now, Mississippi, where the change is more about flexibility. The mandatory break in service before a public retiree can return to covered employment has been reduced from 90 days to 30 days. That alone is significant, but there's more. Under what's called Option C, certain eligible retirees may return to covered public employment full-time, earn up to 80% of the active position's salary, and still continue receiving their full monthly pension. That's a major shift from the earlier rule, where full-time re-entry generally required suspension of pension benefits. Picture a 62-year-old retired Mississippi state accountant who retires in June 2026 with a $3,000 monthly pension. Under the old system, she would have had to stay out of covered state work for 90 days. Under the new July 2026 rule, she may be able to return after just 30 days, work full-time under Option C, earn up to 80% of the active salary, and still keep her pension. For some households, that's a real difference maker. Here's the warning though, and it's a serious one. Retirees may not pre-arrange their return to work with the agency before retirement. Doing so violates the rule and can cause complete forfeiture of retirement benefits. That's not a small technicality, that's a major risk. If you're in Mississippi and thinking about retiring and then returning to public employment, don't assume you can work out the details in advance and clean it up later. The practical action is to confirm the break-in service rule, understand how Option C works in your system, and make sure there's no prohibited pre-arranged reemployment agreement before retirement. Even if you don't live in Louisiana or Mississippi, there's a broader lesson here. State retirement systems are changing. Some are trying to protect retirees from inflation. Others are trying to bring retirees back into the workforce to fill staffing shortages. If you receive a public pension from any state system, this is a good reminder to review your own system's 2026 rules rather than assuming last year's rules still apply. 3 changes, 3 very different mechanics. The first is national. Some Medicare beneficiaries may be able to access certain GLP-1 weight loss medications for a flat, $50 monthly copay under a temporary bridge program. But the eligibility rules are narrow, and the copay doesn't count toward normal Part D spending limits. The second is in New Jersey. Stay-NJ property tax relief is now more tightly targeted, with a lower income ceiling of $200,000 and tiered benefit caps. Some homeowners will still get meaningful relief, others will get less than expected, or nothing at all. The third is at the state pension level. Louisiana approved a limited 2% COLA for qualifying retirees, while Mississippi shortened the break-in service period and expanded return-to-work flexibility for certain public retirees. Here's what I want you to take away from all of this. These aren't headline-only changes. They're fine print changes. And with senior benefits, the fine print is often where the real answer is. If you think one of these updates might affect you, here's your next step. If the Medicare GLP-1 change may apply to you, review your Part D status, your BMI and health conditions, and ask your prescriber whether you fit the bridge criteria. If you're a New Jersey homeowner, review your household income, confirm you meet the age and residency rules, and file the PAS-1 application by the stated deadline. If you're a Louisiana or Mississippi public retiree, check directly with your retirement system before making any pension or return-to-work decision. And if a rule feels unclear, don't guess, especially with benefits, taxes, and retirement income. A short phone call, a benefits review, or a careful check of your paperwork can prevent a very expensive misunderstanding. I hope this helped make these July 2026 changes a little easier to understand. The good news is that some of these updates may create real savings or new flexibility, but only if you know which rule applies to you, and only if you avoid the common misunderstandings. Take it one step at a time, check the details that apply to your situation, and don't let a confusing headline make the decision for you.